during the break, Larry said something pretty funny. It's like, put all your money in a small basket and watch it very closely. So is that the advice we should give?
Yeah, well, that's the advice that we've heard many people say. And, of course, those who worked at companies like Enron and Intel and Eastman Kodak and Polaroid, we can be sure they were watching very closely, paying lots of attention, but it didn't do them any good.
That was with the real estate crisis. There's a lot of real estate investors here in Southern California, and it's like, well, no, I want to buy real estate because I can look at it.
Yeah, I know it.
Yeah,
I can touch it. I can feel it.
Yeah, so when I drive by, I can see it. But yeah, well, it's still underwater. I mean,
well, and of course, here's the craziness of that idea. But so I'll start out by giving you this story, and then we can apply it to real estate. So, Joe, what's if you could think of a city, let's take Atlanta, what's the product that may be most associated with that city? Do you happen to know? Big companies
Coca-Cola.
Coca-Cola, right?
Yeah.
So let me ask you this question. Do you think it's any safer to own Coca-Cola if you happen to live in Atlanta or if you happen to live in St. Louis?
It would make no difference.
Of course not. And yet people who live in Atlanta dramatically overweight Coca-Cola relative to, say, when Anheuser-Busch was a public company, it recently was taken over. They under-own Anheuser-Busch, and the people in St. Louis, of course, because they think they know Anheuser-Busch and the executives there who work there, dramatically overweighted Busch. And, of course, it's no safer to own Anheuser-Busch because you happen to live in St. Louis. And that same mistake applied to the people who lived in Houston and happened to work for Enron. It didn't make it any safer to own that stock. It makes no sense, and yet people believe it. So is it any safer to own San Diego real estate if you look at it than if you live in Atlanta and own the same piece of real estate? Of course not. It's just that we confuse this familiar with the safe.
Well, Peter Lynch had his quote, like, buy what you know.
Yeah, that's exactly right. That's what he said, and I think that despite my great respect for Lynch, who was one of the great money managers of all time, obviously, that was one of the dumbest things that anybody could say. And the reason is you have to ask yourself the question. I remember Lynch giving an example of maybe it was Michael's store. And so if you shop there, you happen to know that the store is busy and it's doing well. Well, that implies that the smart guys at Goldman Sachs and the hedge funds don't send out people to look at the stores, check the monthly sales, et cetera, and they are just so ignorant that they're unaware of the very same things that you are, which of course is nonsensical. And yet that's the advice Lynch gave. It makes no sense. The odds that you are going to know something that's going to give you a competitive advantage over a Warren Buffett, a Peter Lynch, or some hedge fund manager are asymptotically close to zero. And if it is true that you have that information, if you try to trade on it, we all know where you can end up.
In jail.
Yeah, with Phil Mickelson.
Well, that one, it looks like, turns out to be premature SEC jumping on somebody who now it turns out was completely innocent, it looks like. At least that's what I heard this morning.
Oh, really? Oh, well, great advice as always. You got one more quick story before we got to go?
Yeah, I'll tell a story of a young man who came to work for us after reading my first book. And obviously I preach globally diversified portfolios and that individual stock investing has more to do with speculating than investing. So I found out he was telling me a story that shortly after joining us, he bought this high-tech stock, and I told him the worst thing that could happen to him is he'll make money on it because he'll get the wrong lesson. I said to him, be smart, at least put in a stop loss. I forgot, let's say he bought the stock at 50. I said, all right, at 40, you promise you'll get out so you don't watch it go to zero, which I've seen happen. So he did that. Within a few weeks, he was out of the stock having lost money. And today, the young man who happens to run now his own financial advisory firm tells me that that was the single best lesson he ever had, and it was cheap because at the time he was young and had very little money that he could put at risk. So maybe it cost him $1,000 or something like that. If he made the mistake today, it could cost him millions possibly. So he got the lesson early. Don't ever confuse luck with skill.
Yes, and I think most people do confuse that when they make some money.
Even worse, Alan, what they do is they attribute their successes to skill and their failures to bad luck. And, of course, if you keep doing that, at the end of the day, you're a genius. You never make bad decisions. You're just unlucky.
We're talking to Larry Swedroe. Thank you so much, my friend. It was a great conversation. We'll hopefully talk to you again next month. We got to take a short break. Show's called Your Money, Your Wealth, right here on 760 KFMB.